start our meeting today. First of all, let me thank very much the GOP and Professor Grilli to be with us in the organization of this very interesting meeting, very interesting workshop. I would like also to thank the Italy-China Foundation to support our event. This is the aim of the Italy-China Chamber of Commerce. The Italy-China Chamber aim is also to become a kind of platform to discuss topics, to let people to meet, to ease the relationship between Italy and China, and of course to provide updating news from our member companies to the Italian and the Chinese companies. I would like then to thank GOP to propose to us the organization of this event, which is quite interesting because if I'm not wrong, it is probably one of the first time we read and we got the news about this new treaty, and this is the first time, at least for myself, which I take part in an event introducing this new treaty, which is quite important. And this has a double value, let's say. First of all, because we are all trying to recover from this pandemic situation. I do believe that it will not be a process so fast, and we are still waiting to see what is going to happen. Everybody is waiting for the next autumn, not only for the pandemic situation, but also, and this is the things will let me think more, the economic situation. You know that all over the world, the GDP is falling dramatically, all over the world, but China. In China, the IMF is foreseeing a GDP growth from about 1 to 2%. If we compare the situation to the other market in the world, we can see in Italy, I've seen that recently it has been around 11.5% below zero. So it's quite a dramatic situation. So this will let us understand how now China, even more than before, become the main reference point to everybody who want to recover from this situation and to restart business. China not only as a market, China also as partner, and Italy as a partner of Chinese companies. Today's meeting has seen the participation of a quite important number of companies, and we are very glad with this. And most of them also Chinese companies. So it is quite interesting to understand that this new Italy-China tax treaty will probably be very effective also in order to improve the relationship between Italy and China. And this might be a tool also to add to this recovery process. We hope it will end soon. Let's go inside a little bit about the topic of today, New Italy-China Tax and Treaty. We have the pleasure to have Professor Grilli as a guest speaker. Professor Grilli is probably one of the few people who can deepen this topic in all its details. As you know, the Italy-China tax treaty has not been ratified yet, although the Italian Senate approved the draft bill. So we are probably, it is probably one of the first time it has been introduced to the audience, which I believe is quite interesting also. And I'm proud to do this, and proud to say that, because we as Italy-China Chamber with GOP are going to do it. As I say, the Italy-China Chamber is a platform for its member companies like the GOP, and the economic system for Italy and China. At the end of today's event, we will be also glad to share the information, the documents today we're going to discuss and to introduce to you. So if you have, if you would like to receive also those documents, please send an email to us or contact us, and we will be glad to provide you more information, as well as if you are not member of the Italy China Chamber, we will provide you also more information about our association that, as I say, with the Italy China Foundation, represent the most important association related the relationship between Italy and China acting in Italy. So I want to say more words. So I would like to give the floor to Professor Grilli, and we are all eager to listen to this new treaty. Every time we have to deal with tax, the attention raised. So we are waiting for to get the updating and to see if after this new treaty we will get benefit or it will be worse. So Professor Grilli, please, I give the floor to you, and thanks everybody again for joining us today. Thank you.
Thank you. Good morning, ladies and gentlemen, and good afternoon also with respect to our Chinese friends. As anticipated, my name is Stefano Grilli. I'm a partner of a GOP law firm and happens to be also a professor of international tax law at University of Milan and visiting professor of UIB in Beijing, where I teach international tax law. The topic of today is the new tax treaty. Let me share the screen. It's the new tax treaty between Italy and China. Although, I mean, the topic is pretty tricky and it's not a conversational one. We try to simplify the aspects dealt with the treaty and by making a comparison between the new treaty and the old treaty. The old treaty is the treaty currently in force, which has been signed in Beijing over 24 years ago, while the new treaty has been signed in Rome last year in occasion of the visit of President Xi Jinping. And this occasion has somehow influenced the language of some provisions that we will deal with during the course of this meeting. I happen to know some of the people who negotiate treaty on behalf of the Italian Republic, and I happen to talk with them, discuss with them about some language of the treaty, and they explained to me the background of this rationale. Therefore, some of the reason that led to such language has been revealed to me by those individuals, but obviously this is not the official interpretation of the government. This is just some background information. The treaty has been approved under the Italian ratification and constitutional procedure by the Council of Ministers last June 2019, and has been not ratified yet because it has to be approved by both chambers of parliament. And recently, last week, the Senate has approved the first reading of the draft bill implementing in Italy this treaty. So we are on the Italian side, we are getting there. We are not there yet because we need the Congress approving the bill. But once it will be approved, there will be an exchange of notes from the contracting states, and the treaty will come into play. Actually, the treaty will come into play 30 days after the notification from each state, with respect to all the provision, with the exception of first small I and second small I provisions reported in the slides. Because with respect to taxes levied through withholding tax, namely interest, dividend, and royalties, the application of the treaty will become effective the 1st of January of the subsequent calendar year with respect to that of the entry into force. So if in 2020, the Italian Congress and the Chinese Congress will approve the draft bill implementing and ratifying the treaty, the new withholding tax rate would apply as of January 1st, 2021, and so on and so forth, depending on the date of ratifications. With respect to the other taxes, the provision of the new treaty dealing with such taxes will become applicable the 1st with respect to the taxable year, which tends to be the calendar year, following that of the ratification of the exchanges notes between the two contracting states. We tried to set out the main differences between the old treaty and the new treaty. Again, I would not like this being a kind of a lecture or a kind of a class that I may try to do. I would prefer this to be a kind of a conversational one, although the topic it's pretty technical and so we have to dive into some technical details anyhow. So the main differences are taxation of passive income, dividend interest and royalties, taxation capital gain, a new anti-abuse article, which is missing in the currently applicable old treaty, currently applicable treaty, and the new limitations provided for the dual resident entities. So these are the main differences between the old treaty and the new treaty. Note, it is not a difference because the service fee provision, it's a provision which already exists in the currently existing treaty and has been renewed in the new treaty, but is a pretty unusual one with respect to the Italian treaty network. We'll look at it at a later stage, but just as a highlight, this is a particular features of the treaties, old and new, between Italy and China. So if we have to look at the dividend article, which is obviously dividend interest and royalties are, and the PE article, permanent establishment article, one of the main used article in this kind of conventions. The old treaty provides, actually not provided because still it applies, the treaty, the old treaty, for a 10% withholding tax, maximum withholding tax, regardless of the nature of the recipient. While the new treaty has a different language and provides with two separate sets of rates. The first rate is a 5% if the dividends are paid to a company holding more than 25% in the capital of the distributing company for at least 365 days period, including the day of the payment. Which means that if the recipient company has been holding, and this is the tense of the verb is pretty important in this respect, because the language says if 5% of the gross, I'm reading the language of the treaty, which says 5% of the gross amount of the dividends if the beneficial owner is a company which holds directly at least 25%. Holding, it doesn't mean has been holding or has held at the time of the payment to 25% for 365 days. Which means, so if we look at how a similar case is being dealt with by European Court of Justice with respect to the interpretation of the EU directive for the parent sub directive, the language was the same, the present tense was the same because currently the parent sub directive makes reference, uses the expressions maintains. Here the language is holds. And the way it has been interpreted by the European Court of Justice and followed by the Italian jurisprudence and the Italian tax authorities is that the holding period must not be verified at the time of the dividend payment, but it may be verified at a later stage. So it is not clear whether I may, let's say, an Italian company buys 100% of a Chinese company, distributes the dividend one day after, and maintain and holds the participation for 365 days, and whether it is entitled to a 5% withholding tax anyhow, because the monitoring period, the 365 days holding period is verified at a later stage. So if I look at the treaty, the language of the treaty, the fact that it makes reference to holds and not has held, it allows scope for an interpretation pursuant to which the holding period may be verified at a later stage. So which normally means that in my example, the third state, China, will be applying 10% withholding tax rate, which is the fallback rate set out in the second small I, Article 10, paragraph 2, letter B. In any other cases, the rate is 10%. So at the time of the payment, 10% may be the applicable withholding tax. And if at a later stage, the holding period is maintained, is verified, the Italian company, in our example, should be entitled to claim the refund for the exceeding 5%. Because the Italian company may say, I suffered 10% withholding tax at the time the dividend have been paid. But since the holding period has been verified, at a later stage, I'm entitled to claw back the 5%. This is very much something that shall have to be dealt with by the Italian tax authorities, put forward as an interpretation by the Italian tax authority and the Chinese tax authorities. But the language of the treaty, it doesn't say that at the time of the payment, the shareholder must have kept the interest in the distributing company for 365 days. It simply says that if there is a holding period for 365 days, the withholding tax is applicable rate is 5% and not 10%. With respect to interest, I think that we have the most important differences. The currently applicable treaty says the withholding tax is a default 10% source tax, regardless of the nature of the recipient. And then there is an exception from source tax, which basically means from withholding tax, if the interest is paid to government of the other contracting state, the local authority, the central bank, and any financial institution wholly owned by that government. We'll see, I stress financial institution, we'll see at a later stage. Second is case of exception, if the interest is paid to any resident of the other contracting state with respect to debt claims, and here is somehow obscure, meaning indirectly financed by the government of that state, the local authority, or the central bank, or any financial institution wholly owned by that government. Has not been clarified what indirectly means. So if, let's say, a government or a local authority or a financial institution owned by the government finance a non-wholly owned financial institution or an ordinary company, and the ordinary company in its turn finance a company of the other contracting state, is this an indirect finance situation that justify an exemption? So given the obscure language, the obscure meaning of this language, in the two treaty, they changed the language, and also they changed the rate. And they provided for a default rate is 10%, as in the currently applicable treaty, but there is a reduced 8% source tax for loans granted by financial institutions, whether or not wholly owned by the government or any political subdivision of the government, having a maturity of at least 3 years, and that relate to the financing of an investment project. So we have four conditions. First has to be loans. And loans is not, it's not clear whether, because the loan is not typically a security. It's a contract. Why we will see why a security is relevant when we will go to the new treaty. So it has to be a loan. Such a loan has to be granted by a financial institution, whether or not wholly owned by the government. Such a loan must have a maturity of at least 3 years and must be related to an investment project. This is clearly a provision aimed at addressing the infrastructure project attached to the Belt and Road Initiative. So in such situations, no 8% withholding tax. All the other situations, 10%, so it doesn't make any difference between this new treaty and the old treaty. But the new treaty also provides for exemption from taxes when the payer of the interest is the government or a local authority, and the interest is paid, as it's in another situation, second small I, interest is paid to the government or political subdivision, to a local authority, to the central bank, or to any public or private entity wholly owned by the government. So not only financial institution, but any public or private entity wholly owned by the government. So if it's wholly owned by the government, it's not clear what public versus private means. Because, for example, if I look under the Italian law, if it's a private entity, whether it's organized under the corporate law system, and it's a public entity, whether it's an entity which is governed by a specific law of the Italian government. Or public versus private means public is listed and private is not listed. Because if it's listed, it cannot be wholly owned. So this interpretation should be somehow dismissed. Public versus private basically means any entity wholly owned by the government. Third case of exemption concerns interest which is paid on loans guaranteed or insured by the government, the political subdivision, local authority, central bank, of any public or private entity wholly owned by the government. So in this case, also there is exemption. And here is a peculiar provision. Interest arising in Italy and paid to any beneficial owner resident in China, where the issuer is the Bank of Italy, Cassa Depositi e Prestiti, SACE or SIMES, which are Italian public entities. Now, a few comments. The language indirectly contained in the old treaty has been repealed. Also, in the old treaty, there was a reference to, as I was mentioning earlier on, interest paid to financial institution wholly owned by the government. And now this language has been replaced by any public entity and any entity, the capital of which is wholly owned by the government. So the scope has been broadened. A new provision dealing with the loans guaranteed or insured by the government has been added. And then a further exemption has been provided in the new treaty for interest paid by the Bank of Italy, Cassa Depositi e Prestiti, such as SIMES, as issuer. Issuer means only cover a situation where any of these entities issue bonds or issues notes. For example, if there is a loan, a straight loan, not a loan which has been incorporated in a note, in a security, such loan should not, the interest related to such loan should not be covered by the exemption. I happen, as I was mentioning at the beginning, I happened to discuss with the people in charge of the negotiation, and they explained to me that the background was in the context of the visit by President Xi Jinping, the Italian government issued notes to be of treasury bonds to be purchased by the Chinese government and by other entities wholly owned by the Chinese government. So in the context of this, with the context of this background, they used the language issuer because they were referring to the issuance of a security, the issuance of a note. And this is clearly explained in the explanatory memorandum to this new convention attached to the Senate bill aimed at transposing to the Italian law this new treaty, where it's clearly explained that the term issuer makes reference to securities issued. Therefore, this exemption should not apply to loans made by a Chinese entity to Bank of Italy, which is pretty unusual, let's say, by Cassa Depositi e Prestiti, such as SIMES. They have to be securities issued by any of these entities to enjoy the exemption. And finally, this is something not new, point 5, both the old treaty and the new treaty provides that the reduced rate only apply to the portion of the interest that complies with the arm's length criteria. Therefore, The treaty benefits only applies in terms of reduced tax rate or exemption from tax, only applies to the portion of the interest that complies with the arm's length, with the transfer pricing principles. With respect to royalties, as opposed to the currently applicable 10% source tax, the new treaty splits the rates in two rates, 10% for a general IPR returns, which are intellectual property rights returns and royalties, and a reduced rate, which is basically 5%. It's a 10% on 50% of the payment, with respect to the payments for the use of or the right to use industrial, commercial, scientific equipment. It's a pretty curious this, because this language has been repealed in the OECD Model Convention ever since 1977 model. Still exists under the United Nations models, and in the new treaty, this tax rate has been, the source tax for the payment related to the use of the right to use of this equipment has been capped, but with a reduced rate, not any longer 10%, it's 5%. Still, there's some way in between the United model and the OECD model. And normally Italy in its treaty network do not provide, unless we are talking about a very old treaty, i.e. treaty which has been negotiating on the basis of 1963 OECD model. The new treaty signed by Italy, normally they do not encompass they do not qualify as a royalties, the payment for the use of the right to use industrial, commercial, scientific equipment. Typically, containers are payment falling under this provision. Payment for the use of containers fall within this provision. Capital gain, the capital gain rate, there is not much difference. There have been some clarifications. Currently, which is absolutely aligned with the OECD and UN model, the old treaty provides for source taxation of gains realized on real estate properties located in a contracting state, and that it's pretty straightforward. The contracting state in which the real estate, the movable property is located, has the primary right to tax. Any gain, any capital gain, not any income, which is the rental income, because that is covered by Article 6, which is another treaty, which is another article of the treaty. But capital gain related to the sale of a movable property are taxable in the state where the movable property is located. Also, source taxation of movable property forming part of a permanent establishment, or source tax for the capital gain related to the sale of the entire permanent establishment. Here is a slightly source of uncertainty with respect to the source taxation of real estate companies. This is the old treaty, the currently applicable treaty. The language makes reference to a company whose assets consist directly and indirectly, principally, of immovable property situated in a contracting state. It's not clear what principally means. Issued means, obviously, the value of which is more than 50% related to movable property located in one state. In that situation, that state is entitled to tax the capital gain related to the sales of the shares in such company. We have, and it's been maintained also in the new treaty, source taxation in case of capital gain related to the sale of shares in a non-portfolio investment company, which means a participation higher than 55%. And then is a remaining provision that says that any other capital gain can only be taxable in the state of residence. The new treaty basically is in line with the old treaty. There is a clarification with respect to the real estate company, because the company, in order to be considered a real estate company, the value of such company must be more than 50% of the value of the entire company. It's not clear whether one should make reference to the book value or the fair market value. Also, by looking at the OECD works, it should be the fair market value. which means that if a company, whether an Italian company, whether a Chinese company, or whether a third company, has either in Italy or in China real estate assets, and such assets account for more than 50% of the entire value of the company, in case of a sale of the shares of this company, the state where the immovable property are located is entitled to tax such capital gain. We'll see some examples in the next slide. The second clarification of a non-portfolio investment. It is clear that the requirement of the 25% threshold of an interest in a company must be checked for a 12-month period prior to the sale, which means that if at the time of the sale, the interest is lower than 25%, but if at any time in the 12 preceding months, such interest has been of 55%, higher than 55%, then 25% or more in any one day in the 12 months period, the state of the residence of the company is entitled to tax the capital gain, even if at the time of the sale, the participation sold is lower than 25% threshold. So there is a monitoring period, has been clarified. This is consistent with the OECD model and the BEPS project. Therefore, even if you have to monitor the 12 months period, if at any time during this monitoring period, this participation has reached the 25%, then a sale in the subsequent 12 months may be taxed in the state of residence of the company. So with respect to the real estate company example, this is a clear case, straightforward case where we have a resident of state A, which may either be China or Italy, is a shareholder of a company, which is a resident in the other contracting state and has immovable property in this state. The value of the immovable property accounts for more than 50% of the value of company B. In case the shareholder resident state A sells the shares of company B and realizes a gain, the treaty provides for state B, allows state B to tax the capital gain. Because even if this participation in our example is 100%, but to make it more meaningful, if the resident of state A has a participation of 5%, obviously the 5% would mean this participation would not be caught by the non-portfolio interest. Therefore, we have this provision that comes into play, the real estate company provision, which enables state B to tax the capital gain related to the sales of the 5% on the capital gain realized by state A residents upon sale of the 5% shares of company B. This is a more tricky situation, more and more kind of a university example. In this case, the provision does not apply because the provision requires a bilateral scope with respect to the shareholder and the state where the assets are, the immovable properties are located. In this situation, company B derives more than 50% of its value from a real estate property located in state A. Therefore, the provision of Article 13, paragraph 4 does not apply. Therefore, the ordinary provision of 13.5 applies. So if the state participation of a resident of state A in company B is more than 25%, or at least 25% in the 12 preceding months, state B is entitled to tax. And a third case, which is a more tricky one, I put just for explanatory purposes the flag of Italy and China, but they could very well be reversed. If a resident of Italy has a participation in a non-contracting state company, let's say Luxembourg, let's say any other company, who has immovable property in China, and if the value of company B is more than 50% related to the real estate properties located in China, assuming that the resident of Italy sells the shares of the state B company that, for the sake of our example, is a Luxembourg company. Since this Luxembourg company derives more than 50% of its value from a movable property located in China, China, under the treaty, is entitled to tax that gain. Now, obviously, there is an issue. How can China be aware that a resident of Italy has sold shares of a Luxembourg company which derives more than 50% of its value from immovable property located in China? And there is also a complementary issue. We have to check whether Chinese domestic law has a provision that allows this kind of taxation. For example, if we reverse the state and we have a Chinese resident having the shares in a Luxembourg entity, having a real estate in Italy, it is true the treaty allows Italy as a state of location of the movable property to tax the capital gain that the Chinese resident has derived upon the sale of the shares in the Luxembourg company. This is what is allowed by the treaty, but the Italian domestic law does not have a taxing provision, which basically means that the treaty allows Italy to tax, but Italy doesn't want to tax because under its domestic law, there is no such provision that enables Italy to levy taxes upon the sales of a capital gain done by a Chinese resident with respect to the shares of a Luxembourg company or, let's say, a non-Italian company deriving more than 50% of its value in connection with immovable property located in Italy. So the treaty allows, Italian domestic law does not provide with this source taxation. And now there is a new provision, which is a provision that does not exist in the currently applicable treaty, which is the anti-abuse clause. This anti-abuse, it's a kind of a pure, obviously pure, it's a term of art, it's not a term of law, a term of art by analyzing the OECD BEPS work, because it's a principal provision which says that a treaty benefit can be denied if, having regard to all the relevant facts and circumstances, obtaining such benefit was one of the principal purposes, sorry, there is an S missing, of structuring the transaction. So it doesn't have to be the main purpose or the essential purpose. And main and essential are languages used by the European Court of Justice while creating the jurisprudential concept of abuse of law within the EU concept. Now, it is made clear that if obtaining such benefit is one of the principal purposes of the transaction, the treaty benefit should be denied unless the obtaining of such benefit is in line with the object and purposes of the treaty. So the concept is pretty clear, but the language is a way too broad and undefined. So how you measure the principal purpose? When the purpose is one of the principal reasons why a company enter into this transaction. How do you measure? Measuring the tax purpose is a kind of easy because obviously you measure the tax benefits and you can easily measure in terms of euros saved. Now, how can you measure the other purposes? What if there are reorganization purposes, business purposes? How do you measure the business purposes? How do you compare a business purpose in which may have effect across a time span of several years, which you are not in a position to clearly compute on dollar basis, and to compare it with an immediate tax saving? How can you average out whether the business rationale for doing this is at least as important as the tax benefit. So the language, it's a pure, because it's obviously it's a principal provision. It's not a LOB clause. It's just sets out the principle, and obviously this will create some room for the tax authorities to try to deny the application of the treaty, and obviously room from the taxpayer to go to search for a mutual agreement procedure or a kind of negotiation between the agreement between the contracting state, Italy and China, to solve the case. So, but the language is pretty broad, and within such broad meaning, each party, basically meaning the taxpayer and the contracting state, are allowed to put forward their reasoning, and this will not ease the easy and straightforward application of the treaty, because each and every time there is a pretty gray area transaction, the tax authority may claim, well, you did this because you wanted to get the tax benefit. And unless we are able, we as a taxpayer, we are able to prove that this benefit is absolutely in line with the object and purposes of this treaty, the tax authority has room for denying the benefit, and then therefore this will obviously force the taxpayer to go for a mutual agreement, to ask the tax authority to sit around the table and to ask for an MAP, so mutual agreement procedure, or an arbitration situation whereby the benefit is ultimately denied or ultimately granted. And there's also the fact of granting or not granting the benefit is reflected in the new provision of Article 4, Paragraph 3 that deals with dual resident company. The current applicable treaty is drafted along the OECD model prior to the 2017 model, which says that the company is resident in the state where the place of effective management is located. The new treaty says in case of dual resident company, which is a company that on the basis of the Italian domestic law is resident in Italy, on the basis of the Chinese domestic law is resident in China. There is only one criteria which enabled the company to be resident in one of the two contracting states only, and it's a mutual agreement procedure. Therefore, if the Italian tax authority claims that the Chinese company is resident in Italy because it's effectively managed in Italy, and the Chinese tax authority claims that the company is actually resident in China because it's incorporated in China and or is also effectively managed in China under the lenses of the Chinese domestic law. So we have a conflict of the two domestic law. Under the Chinese domestic law, the company is a resident of China. Under the Italian domestic law, the company is a resident of Italy. So we have the clash. And this clash creates an issue with respect to the application of the treaty, because the treaty works under the dichotomy state of source, state of residence. The treaty cannot work under the situation where a company is considered to be resident of both states. And that's why the OECD model, ever since the first model, 1963, provides for a tiebreaker rule, because the model needs to have a state of source, a state of residence. Now, the tiebreaker rule provides for a mutual agreement procedure, which means that the contracting state must sit around the table and find out the solution as to whether the company is actually and ultimately resident in Italy or ultimately resident in China. Pending this provision, so pending this negotiation, which it's necessary to highlight that it's not an obligation of the contracting states tax authorities to come up, or competent authorities, sorry, to come up with a solution. It's only a best effort, because the language is shall endeavor. So pending this negotiation, which may last years, hopefully not, but there is this risk in another situation, real life situation, the negotiation lasts more than 1 year, fairly more than 1 year. The company is not treaty entitled. Not being treaty entitled, it means that it suffers full taxation in Italy, full taxation in China, and likely with no double taxation relief. Because, for example, the Italian tax authority happens to say that we grant relief also under the domestic law as long as such relief should be granted also under the treaty, if any. And since in this situation, the treaty exists, but provides for no relief because it's a dual situation, it's a dual resident company, and the treaty clearly contemplates the situations where no relief is given, and clearly says that the situation where no relief is given to dual res company is not a taxation not in line with the treaty, which means that in situation where, to put it positively, situations where there is a dual resident company, pending the mutual agreement procedure, such dual resident company may be taxed by both contracting state as state of residence. Accordingly, no tax treaty relief is allowed to the company, and this double taxation is in line with the treaty. Being a taxation in line with the treaty, it is doubtful whether there must be the taxpayer is entitled to go for the arbitration, which it doesn't seem to me that exists in arbitration. Sorry, something happened. Share screen. Do everybody is watching my screen?
Sì.
Okay. So this is a pretty tough provision, which is not new, is not peculiar of this treaty, is the new OECD model convention that provides for this provision. Therefore, dual resident company.
Stefano, scusi, l'unica cosa non la vediamo a schermo proprio totalmente intero, se può allargare.
Oh, sorry.
Perfetto.
Okay, sorry about that. I don't know what's happening. So this is a new provision. It's pretty tough because if a taxpayer finds itself in a position where both contracting state claim this to be a resident of that state, it will have to face hard times because the tax authority will be entitled to tax fully with no treaty benefits, full double taxation, which will not be resolved until the competent authorities reach an agreement, if an agreement is reached. Pending this agreement, full taxation, unless obviously both countries, while carrying out the negotiation procedure, allow such company to enjoy some specific benefits provided for by the treaty. Again, this is a new provision of the Italy-China treaty. It's not a brand new in the international tax landscape because it's the OECD 2017 model that provides with this scenario. And since the treaty has been negotiated in 2019, this treaty complies with this provision of the OECD model. But it's a pretty tough one. So taxpayers should make sure not to fall within this particular situation. Service PE. The service PE, again, as I said at the beginning, it's not a new provision because it existed in the old treaty, which is the currently applicable treaty, and it will exist in the new treaty. This provision allows source taxation in connection with the provision of services, including consultancy services, by an enterprise of a contracting state, which has employees or other personnel physically located in the other contracting state, provided that such activities continue with respect to one project or a connected project for a period, one period or more periods that in aggregate last more than 6 months within any 12 months period. So it's not 6 months in any calendar year, but is a 6 months in any 12-month period, which may be a period across a calendar year. This provision, as it is my comment, will mainly work in favor of China because, for example, we have several clients which have operating company in China, and from time to time they send employees over there. For example, in case of when they set up joint venture with Chinese partner for the production or manufacturing of specific products, they normally send people, technicians from Italy who work there for a significant amount of time to set up the factory. And this provision enables, in this example, the Chinese government to qualify this as a permanent establishment. It's called service PE, service permanent establishment, and allows the Chinese government, in this case, to levy tax on the income attributable to that permanent establishment. This is a pretty unusual, this provision in the Italian treaty network, because we normally rely on the OECD Article 5 definition of permanent establishment, which normally does not have any service PE. Again, this is a peculiarity of the Italy-China treaty. It's not a new peculiarity, it's a peculiarity already existing in the current applicable treaty. So we all should be familiar with how this system and provision works. Well, just the purpose of this highlight would just to highlight that this peculiar provision already existing has been kept in the new provision. Again, something already existing, the agency PE. The agency PE is a peculiar feature of the permanent establishment where there is no physical presence of a non-resident company in the economic territory of a contracting state. So when a person acting in a contracting state on behalf of an enterprise resident of the other contracting state, just to make an example, if a person acting in Italy on behalf of a Chinese resident company has the authority to conclude contract and habitually exercise such authority to conclude contracts in the name of the Chinese enterprise, the fact that the Chinese enterprise is not a physical presence in Italy is not relevant, because the activities, the operations of the Italian resident, which has been acting in here's the important point, in concluding the contracts on behalf of the Chinese company, makes the latter, i.e. the Chinese company, to be economically present in Italy, and therefore these operations of the Italian resident qualify as an agency permanent establishment, which means that Italy is entitled to tax the income attributable to that permanent establishment. But this is not the peculiarity. The peculiarity of this is that, differently from the language of the OECD model, this treaty, i.e. the new treaty, only makes reference to the ability of an Italian resident to conclude contract on behalf of the Chinese enterprise. While the language of the OECD model makes reference not only to the ability to conclude contracts and the fact that of usually concluding contracts, but also the fact of playing the principal role in leading to the conclusion of the contracts, which means under the Italian interpretation, under the OECD model, under the Italian interpretation, which when I say Italian interpretation, I mean interpretation put forward by the Italian tax authorities in audit performed to Italian company that ultimately led to case law, so the Italian jurisprudence. Also the fact that an Italian entity or an Italian resident, whether corporate or individual, has the authority to conclude contracts, surely triggers the existence of a permanent establishment. But even if it doesn't have the legal authority to conclude contracts which are binding on the Chinese company, if in any case has the ability to take part of the negotiation and has the principal role in leading the negotiation. So basically, if the party has arranged the legal feature in such a way that the Italian resident de facto negotiate everything, or the most important part of the treaty, sorry, of the contract, and then simply says, sorry, I cannot sign the contract because I am not legally entitled to do so. So the party who has the authority to sign the contract is only the Chinese company resident in China, does not prevent, under the Italian interpretation, the existence of a permanent establishment. So the mere fact that the Italian person doesn't have the legal title to bind the Chinese company, it's not an issue under the Italian domestic law, under the Italian interpretation put forward by the Italian tax authority, and under the Italian interpretation put forward by the Supreme Court and lower courts. But the treaty, which has been signed after the OECD model, the 2017 OECD model, doesn't make a reference to the ability or to the activity of the Italian resident to play the principal role in leading to the conclusion of contracts. So what does that mean? Does it mean that if a Chinese company is a legal presence in Italy in such a way that the Italian representative doesn't have the legal authority to bind the Chinese company, that a permanent establishment does not exist? Because in 2019, although the 2017 OECD model allows for, or provides for this provision, whereby if an entity which does not have legal entitlement to bind a non-resident entity, but in anyhow plays as an important role in negotiating the contract, does qualify as a permanent establishment. But this treaty, real life treaty, 2019 Italy-China treaty, does not provide for this provision. What that actually means, it means that the Chinese, in our example, the Chinese resident may arrange its presence in Italy by having someone here negotiating the contract but not signing the contract, and this does not create the existence of a permanent establishment. I spoke with the tax authority in this respect, to the person who was participated to the negotiations. And basically, he realized that there may be an issue here because the OECD model 2017 required this language or clarified this, and the 2019 real life Italy-China model is silent on this. So there may be scope for maintaining that the mere presence in Italy for someone that negotiates the contract, which means plays the principal role in leading to the conclusion of the contract, but doesn't have the authority to conclude contracts, may disqualify of a permanent establishment, of the existence of a permanent establishment. So it's a gray area. We have to pay attention to this. And then there is the general clause of the OECD model and of the China model that says that if the Italian resident acts as an independent agent in the ordinary course of this business, obviously there is no agency PE. But then there is an exception under the new Italy-China treaty, which says that if this entity is acting for a related party, the fact that this entity is acting is not independent, basically, even if it's acting in the ordinary course of his business. If it's a related party to another, if it's a related party and the related party is a resident of the other contracting state, the exception of which it crosses out the existence of a permanent establishment doesn't apply, which means that if let's say 50+% controlled Italian entity controlled by a Chinese entity, even if the Italian entity is acting in the ordinary course of its business by negotiating or binding the Chinese, negotiating contracts and binding the Chinese company with respect to those contracts, this exception does not apply, which ultimately means that the Chinese company has an agency P in Italy by virtue of the operations of the related party acting within the Italian territory by negotiating, question mark for the reasons seen below, or in connection with the conclusions of contract done in Italy. So I realize it's pretty complex a matter to be explained in a few words, but basically, if the Italian entity or the Chinese entity, as the case may be, but if we stick to the example of a Chinese company having a subsidiary in Italy, and this subsidiary acting in the ordinary course of its business, conclude contracts in the name of the Chinese company, a permanent establishment exists. Because the new treaty provides for an exclusion of the exception, the denial of the exception, which means permanent agency P exists. No particular situation with respect to the employment income. The treaty is OECD pattern. The Article 15 of the Italy-China Treaty is a pattern along the line with OECD. For only peculiarity is severance payments, because the treaty provides that if, let's say, I read the clause, payments received by a resident of the contracting state, let's say an Italian resident, after having ceased to be resident of the other contracting state, China, and derived by virtue of his employment in China, as a severance indemnity or a similar lump sum payment shall be taxable only in China. So this is a peculiar provision of this treaty. It's not the OECD model. So therefore, taxable only in the state of residence of the recipient for past employment activities rendered in the other contracting state. So this is the only highlight with respect to Article 15. Stock option is ordinary applicable, so there is nothing new. I reported in the slide how this would apply, but I think that in the interest of time, I have to stop my presentation shortly, so I do not go through the slide, but simply this is an example of how the stock option plan for a Chinese resident coming to work in Italy or Italian resident coming to work in China. The vesting period is partially in China, partially in Italy. How the taxation right will be allocated between the two member states is nothing new, nothing peculiar in this treaty. It's the typical OECD model approach. Two examples. Director fee, nothing new. Old treaty as opposed to the new treaty, and both treaty as opposed to the OECD model. So I stop my presentation here. Sorry if I've been indulging too much in some of the details of the treaty, but as I said, it's a pretty technical subject and not very much conversational. I hope it didn't come out as more as a lecture university rather than as a. The purpose of this was more of an illustration purposes rather than a teaching purposes. So now I stop here and happy to answer to any questions, if any. And thank you for listening to me.
Is there anyone who would like to ask any question? You can either just talk or write in the chat. There's one person who raised the hand. please.
Hello, can you hear me?
Yes, we can hear you.
Thank you. I'm Joyce, and I worked for a joint venture in China. So my question is about the Article 5 permanent establishment of the new tax treaty. So in this article, in term 2, it says that the permanent establishment includes a place of management, a branch, an office, etc. And again, in term 3, it also said that a service permanent established includes if the employee was sent to another state for more than 183 days. So let's say if there's a Italian headquarters which set up a joint venture in China, and in the operation, it provides IT service to the Chinese joint venture. However, no employees were physically sent to mainland China to perform any service. So is it means that there is no permanent establishment was established in mainland China, or even yes, please go ahead.
Well, if there are no physical employees physically present in China and rendering the services, employees of the Italian company, obviously there will be no PE, because the language requires the furnishes 5.3b, the furnishing of services, including consultancy services, by an enterprise of Italy through employees or other personnel engaged for such purposes, meaning it may be Chinese personnel. It doesn't say it has to be Italian personnel or personnel resident of a contracting state. It simply says employees or other personnel engaged for such purposes. That qualifies as a PE, but only if activities of that nature, which is services, consultancies, continue with respect to the same or connected project within a contracting state for a period or periods aggregating more than 103 days. So if there are no employees or other personnel, which means the dichotomy between employees and personnel mainly relates to the labor law, and employees is an employee of a company. Personnel may be an external counsel, which is not an employee, but still is a person working for the Italian company, physically present. This is a condition precedent. If the individual is not physically present in China, then there will be no PE.
Okay, thank you very much. So in this case, there will be no corporate income tax raised for the Italian corporation, right?
There will be no permanent establishment in China, therefore no corporate income tax levied in China on the specific of permanent establishment. Yes. There will be no economic present, no tax liability on this.
Okay, thank you very much. Can I have a second question? I only have 2 questions though.
No problem. Yes, you go on.
Thank you. So as you mentioned that it is better that any entities will not raise a dual tax resident in both countries, because it would be very trouble. But however, if it does happen, is there a very clear way to trigger the mutual agreement procedure in both countries? Because it is only like very vaguely mentioned that there is a procedure, but there's no way to mention that how to start this procedure or how to officially raise a question or raise.
Well, this is an issue also because also with respect to the OECD model. If you look at, I do not remember the name of the paragraph, but the commentary on Article 4, I think it's, I don't want to give numbers, but it says that there must be a mutual agreement procedure with respect by the two contracting, to the competent authorities of contracting state in order to solve the dual resident issue. It is not clear whether you can go to the Article 25, which is to the 26 of this treaty, which is a mutual agreement procedure, and rely on the procedure. And there is also an arbitration clause, which is not reported in this real life treaty. So basically, under the Italian law, and let's assume that obviously being a dual resident company, Italian tax authority will say, well, this is a resident of Italy, so the taxpayer shall have to go to the tax authority and ask to the Italian tax authorities to raise the issue with the Chinese tax authorities, to call them around the table and negotiate for a settlement.
Okay,
the procedure is not very much detailed, and for sure there is no arbitration clause here. But even if there were an arbitration clause, it's not even clear whether such clause could be activated as a result of a dual resident issue. This is something that, I don't know whether you happen to read, there is an important tax magazine, International Tax Studies, published 2 years ago, a very extensive article of 80 pages on the new Article 4, Paragraph 3. And also in this article, it's clearly reported that it's highly uncertain as to whether the unsuccessful mutual agreement procedure by the competent authorities of the contracting state with respect to dual resident company can be brought in the arbitration clause. So it's a very gray area with respect to the procedural aspect. At least for the Italian perspective, you go before the tax authority and you ask them formally with a letter to start the arbitration, the mutual agreement procedure, sorry, not the arbitration. So there are no formalities in this respect.
Thank you very much.
Pleasure.
Anyone else?
But sorry, just one further comment to this last bit. If you read Article 26, Paragraph 1, says, where a person considers that the action of one of both contracting states result or will result for him in taxation, and here's the important bit, not in accordance with the provision of this agreement, he may blah, 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 blah. Now, is a taxation of a dual resident company a taxation not in accordance with the provision of this agreement? Very likely it is not, meaning it is a taxation in accordance with. Why? Because if you look at Article 4, Paragraph 3, it clearly says that to a dual resident company, the double tax treaty benefit would be denied unless the competent authorities would agree to allow one or more specific specific benefit, which means that the denial of the treaty benefit is not a taxation not in line with the double tax treaty, which means, to say it positively, being a taxation in line with the double tax treaty, you are not entitled to go to the mutual agreement procedure under Article 26. And that is why in the commentary in Article 4, there are two lines that somehow seem to mean that you can go, in any case, you can ask the tax authority to start a mutual agreement procedure not under Article 26 of this treaty, but under, let's say, Article 4, Paragraph 3, to come up with a solution. But it has to be clear that a taxation of a dual resident company, whereby to such company the benefits of the treaty are denied, it is not a taxation not in line with the treaty. Not being a taxation not in line, the mutual agreement procedure in Article 26 seems to be not applicable. In any case, there must be a forum where the Italian tax authorities and Chinese tax authority must meet and get to an agreement. And this forum is not clearly defined in Article 26, but it is something impliedly meant by Article 4, paragraph 3. And last, and then I stop saying, if you look at the MLI, the explanatory memorandum of the multilateral instrument with respect to Article 4, paragraph 3, it clearly says that a double taxation of a dual resident company is a taxation in line with the treaty. Therefore, you cannot go under the mutual agreement procedure of Article 25, if I remember correctly, the CD model. You have to stick to the Article 4, paragraph 3. It's something that it needs to be addressed by the treaty and the OECD, because this is a very gray and obscure area with respect to the mutual agreement procedure for dual resident entities. Sorry if I've been a bit too technical or for the rest of the audience.
There's actually another question in the chat. I'm gonna read it if it's okay for you. Regarding the exportation of goods from Italy to China, has anything changed?
No. Oh, I'm not familiar with the excise duties, but it doesn't make any difference. I mean, the new treaty as opposed to the old treaty, to this effect, doesn't make any difference.
Thank you very much. Well, I think the time is quite arrived to the end. So maybe if anyone would like to ask any kind of question or would like to have more clarification regarding the presentation, you can just email to me to events, the email from which you received the user password of this webinar. And I'm going to put you in touch directly with the speakers for any clarification. Okay, so thank you very much to Mr. Grilli, first of all, and to all participants for joining this webinar, and hope to see you soon in person, maybe. Okay.
Thank you all. Thank you to the Italian and Chinese Italy Chamber of Commerce.
Thank you, everybody.
Thank you, Stefano.
Bye-bye.
Bye-bye.
Thank you.
Bye.
Bye.